Hello and welcome back to the Geordie Pig Investor channel. Today's the day. After many requests from different subscribers, I'm finally revealing my full Trading 212 UK dividend growth pie. This portfolio is designed for long-term, sustainable passive income with a focus on solid UK dividend payers, consistent growth and compounding power. I'm a huge fan of this portfolio as every single holding is listed on the London Stock Exchange, and because I hold all of the stocks with an ISA account, all dividend payments I receive are tax free. Whether you're a beginner looking for a starting point or a seasoned investor curious about what's inside, this is the deep dive you've all been waiting for. I'm going to break down each stock, the weighting, the yield, and exactly why I picked each one for this portfolio. If you want to see a similar breakdown for my US dividend growth pie, then smash the like button. If this video reaches 100 likes, I'll make sure and do it. As you can see on screen, the dividend yield currently sits at a very promising 5.33%, and my yield on cost is closer to a staggering 6%. Yield on cost is important because that shows you what yield you personally are receiving from the investments you have made, because if you were to buy a stock and then it was to say go up 10%, the yield on offer would now be lower than the yield you were able to buy it at, giving you a higher yield on cost. So it is essentially a measure used by investors to evaluate the income return from an investment based on the original amount invested rather than its current market value. I find it really useful because it tracks long-term income growth, which is great for us dividend growth investors, and it also highlights how your investments is paying you more over time. Not only this, as shown on screen, here you can see this pie has a 5-year dividend growth rate that currently sits at 11.63%, so it's not only paying you well, but also going to be a compounding king. If you're wanting to follow this exact pie, then you can do so by clicking the link in the description of this video. Let's get straight into it. The first stock in the portfolio is BAE Systems, stock ticker BA. BAE Systems plc is a British multinational defence, security and aerospace company. It is one of the largest defence contractors in the world, serving governments and militaries globally. BAE's key clients include UK Ministry of Defence, US Department of Defence, NATO allies, and various Middle Eastern and Asia Pacific countries. They are also involved in next-gen aerospace programs, including hypersonic weapons, satellites, and military drones. As you can see on screen, BAE Systems' current price is £19.32, have a market cap at 56.72 billion, went public back in 1981 with a 9-year dividend growth streak, have a 5-year dividend growth rate at 6.46%, and a dividend yield that currently sits at 1.71%. As you can see from the graph, they have had a fantastic year to date, being up 68.22%. I own BAE Systems because it sits at the intersection of defence, technology and geopolitical necessity. In a world that's becoming increasingly unstable, defence spending isn't just holding steady, it's actually growing. BAE benefits directly from this with long-term government contracts, a global footprint and strong relationships with major allies like the UK, US and NATO. Beyond that, the company is expanding into high-margin areas like cybersecurity, space, and next-gen military tech, giving it both defensive stability and growth potential. It also pays a solid and growing dividend, which strengthens its appeal as a long-term income play. So whether you're looking for resilience in uncertain times, exposure to defense innovation, or simply a reliable cash-generating machine, BAE Systems checks all the boxes, and that's exactly why it has a spot in my UK dividend portfolio. The second stock in the portfolio is one that is featured a few times in my videos lately. It is none other than Legal & General's stock ticker LGEN. Legal & General Group plc is one of the UK's largest financial services and asset management companies. It's best known for its role in insurance, pensions and investment management. Legal & General earns revenue from insurance premiums, management fees on investment products, return on invested capital, and annuity profits from retired deals. The company reinvests profits into high-quality long-term assets that match its pension and annuity liabilities, making it a long-duration, very reliable company for investors. As you can see on screen, their current price is £2.53. They're part of the financials industry, have a market cap at 14.51 billion, when public back in 1979 have a 9-year dividend growth streak with a 4.25% 5-year dividend growth rate and a massive yield that currently sits at 8.43%. Year to date, they're actually up 10.31%, and I own Legal & General because it's one of the few companies that combine stability, consistent income, and long-term structural growth. It's a powerhouse in pensions, insurance, and asset management, and it's in a sector that benefits directly from an aging population and growing retirement needs. With a dividend yield often north of 7%, backed by strong free cash flow and a conservative balance sheet, Legal & General offers reliable income without sacrificing long-term potential. Its unique strategy of investing in real assets like housing, infrastructure, and clean energy gives it exposure to high-quality, inflation-resistant returns. Simply put, Legal & General is a sleep well at night stock. It's steady, essential, and quietly compounding wealth in the background, which is exactly why it holds a core spot in my portfolio. The next stock in my portfolio is B&M Bargains, stock ticker BME. B&M Bargains is a discount retail powerhouse built on high volume, low margin sales in cost-conscious markets. They've had rapid store growth in the UK and are expanding their presence over in France alongside having a very strong free cash flow. It has approximately 865 stores across the UK and France, with 741 in the UK, 124 in France, and over 300 Heron Foods and B&M Express outlets. They are only expanding the business by opening new stores every single year, with a target of over 1,200 UK stores, and just last year alone they managed to open 47 new UK stores. This is the only company in my UK dividend pie that isn't listed on the London Stock Exchange, as they are still based in Luxembourg, so you will have to pay a 15% withholding tax on any dividends you do receive, so bear that in mind. They are actually in talks of relocating to Ireland, which would mean the withholding tax would be wiped out for us UK investors, so I really hope this does happen in the near future. As you can see on screen, their current price is £2.70. They have a market cap at 2.71 billion, went public back in 2014 and currently have a 2-year dividend growth streak. They have a 5-year dividend growth rate at 35.12% and a very healthy yield that currently sits at 5.55%. Not only do they have a very nice yield, but they also have paid a special dividend over the last 2 years, which pushes that dividend yield above the 8% mark if they are to do that again this year. Their current share price is down 26.4% year to date, and I have recently bought into the stock in this crazy dip, so right now I'm actually up on my position and I do think it's a great opportunity to buy this stock. I own B&M because it's a pure play on value retail. This is a sector that thrives in both good times and bad. As inflation squeezes consumers, more people turn to discount retailers, and B&M is perfectly positioned to benefit. With its no frills, low cost model, efficient sourcing and growing footprint across the UK and France, it delivers consistent revenue and strong cash flows. What really stands out is the company's ability to generate high returns on capital, expand aggressively without piling on debt, and return substantial cash to shareholders, often through special dividends on top of a solid base yield. B&M might not be flashy, but it's exactly the kind of cash generating defensive growth stock I want in my portfolio. It's simple, scalable, and built to weather economic cycles, and that's what makes it a great long-term hold within my UK dividend pie. The next stock in the portfolio is British American Tobacco, stock ticker BATS. This is one of the largest tobacco and nicotine companies in the world. It operates in over 180 countries and owns some of the most recognizable cigarette and vaping brands in the world. The core business is still traditional cigarettes with flagship brands like Dunhill, Lucky Strike, Rothmans and Kent. These products continue to generate the bulk of revenue and profits, especially in emerging markets. Having said this, BATS is aggressively pivoting towards reduced risk products including vaping and heated tobacco. These segments are growing double digits and is part of BATS' A Better Tomorrow strategy to reduce health impact and diversify away from traditional smoking. As you can see, their current price is £36.50. They have a market cap at 80.06 billion, went public back in 1912, have a 9-year dividend growth streak and a 5-year dividend growth rate at 2.59%, which is actually the lowest in this UK dividend focused portfolio, but they do have a yield to make up for it at 6.58%. And year to date, they've had a very strong performance, being up 26.74%. I own British American Tobacco because it's a cash flowing machine with a long history of paying and growing dividends. Despite all the noise around regulation and ESG concerns, BAT continues to deliver strong earnings, high margins, and consistent returns, even in uncertain markets. What makes it stand out in my dividend growth portfolio is its massive yield, often around 8%, supported by resilient free cash flow and a disciplined payout strategy. I love the fact that BAT is actively shifting its business model, and it shows me that it is a company planning for the future, not just milking the past. It's boring, it's defensive, and it compounds quietly in the background. Exactly what I want from a core dividend holding in my portfolio. That's why BAT remains a cornerstone in my UK dividend pie. Next up is Greencoat UK Wind, stock ticker UKW, and this is a UK listed investment trust dedicated to owning and managing operational onshore and offshore wind farms in the UK. Their revenue is generated from selling clean electricity to suppliers and benefiting from inflation-linked subsidiaries. Their goal is to provide an inflation-linked dividend and preserve capital over the long term, reinvesting surplus cash or returning it to shareholders via buybacks. This means that their huge dividend payment should be growing at the same rate of inflation, so your dividends won't be shrinking year on year and you can enjoy the high yield too. As you can see on screen, their current price is £1.17 and they have a market cap at 2.62 billion with a 7-year dividend growth streak and a 5-year dividend growth rate that's currently sitting at 9.68% with a massive yield currently at 8.82%. Year to date, they're down 7.99%. And I own Greencoat UK Wind because it offers something rare in today's market: high inflation-linked income backed by real assets. With a dividend yield of nearly 9%, underpinned by long-term government-backed contracts in operational wind farms, UKW delivers consistent, predictable cash flow year after year. It fits perfectly in my dividend growth strategy because it's not just paying out, it's covering that dividend nearly 2 times over with actual cash. Plus, with the shares trading at a discount to NAV, I'm effectively buying £1 worth of assets for under 80p. That's value, yield, and long-term sustainability all in one package. In a world chasing growth at any price, Greencoat gives me dependable, inflation-beating income from the clean energy transition, and that's exactly why it holds a key spot in my UK pie. The sixth stock in my portfolio is Safestore Holdings, stock ticker SAFE. It offers storage units ranging from small lockers to large containers, targeting both personal and business customers, supported by services like insurance and packing supplies. Safestore is the largest in the UK and second largest in Europe, with around 200 facilities across the UK, France, Spain, the Netherlands, Germany, and in Belgium. They own a mix of freehold and leasehold sites with a strong presence in London and Paris. As you can see on screen, their current price is £6.68. They have a market cap at 1.46 billion with a 7-year dividend growth streak and a very nice 5-year dividend growth rate at 12.65% with a yield that currently sits at 4.55%. Year to date, they're slightly up at 3.73%, but as you can see, around April time, they did take a massive dip, so there was a great buying opportunity around that point, although I do still believe that they are undervalued. I own Safestore Holdings because of its rare combination of reliable income, long-term growth and resilience, and I love the business models of REITs, as for me, this is one of the best REITs on the market, and especially because it's based on the London Stock Exchange. As the UK's largest self-storage provider with a growing footprint across Europe, Safestore benefits from consistent demand in urban areas where space is limited and moving trends never stop. What really makes it stand out in my portfolio is the steady, inflation-beating dividend backed by high occupancy rates, strong cash flow, and a conservative balance sheet. Even in tougher economic environments, people still need storage, making this a recession-resilient, low volatility asset that keeps delivering. For me, Safestore is just another quiet compounder in my portfolio, like many of the other ones I've already mentioned in today's video. Next up in the portfolio is Shell, stock ticker SHEL. They're a major global player, second in profitability only to ExxonMobil, with operations in 140 plus countries and around 90,000 employees. They are also expanding into lower carbon solutions, including carbon capture, EV charging networks, and some investments in renewables, although traditional fossil fuels remains the priority. Shell aims to maintain oil production at 1.4 million barrels a day and grow LNG volumes by 4 to 5% annually to 2030, positioning itself as an integrated gas powerhouse. As you can see, Shell's current price is £26.95. They have a market cap at over 160 billion. They have a dividend growth streak at 3 years with a 5-year dividend growth rate at 8.53% and a yield that sits at 3.99%. They are currently up 8.87% year to date, and I own Shell because it's a cash flow powerhouse with global reach, real assets, and a deep commitment to shareholder returns. Even in a volatile energy environment, Shell continues to deliver a 4% dividend yield, regular share buybacks, and one of the strongest balance sheets in the sector. What makes it stand out in my dividend growth portfolio is the combination of resilient earnings, exposure to high margin LNG, and its steady transition towards lower carbon energy, all while still rewarding investors today. It's not just a bet on oil. Don't get me wrong, in 30 to 40 years time my opinion may change on this company depending on how they've adapted, but at least for the next 1 to 2 decades I don't see them going anywhere and just continuing to go from strength to strength. Shell gives me a reliable income, inflation protection, and upside potential, which is exactly why it earns a place in my long-term UK dividend growth pie. And finally, to finish off my UK dividend growth portfolio, I have the most well-known Geordie stock on the market, known as Greggs, stock ticker GRG. Greggs are a Newcastle-based UK food-on-the-go bakery chain offering savoury pastries, sandwiches, hot drinks and snacks like their famous sausage rolls and vegan alternatives. They operate over 2,500 branches, including high street, motorway services, public hubs, franchise, and delivery via Just Eat and Uber Eats. They are fully vertically integrated with 21 manufacturing sites supplying the chain, enabling fast product innovation and strong cost control. They generate most of their revenue from bakery and pastry items at over 70%, and they are focusing on store expansion, having opened 223 stores in 2023 alone, and offer strong product innovation with seasonal ranges, plant-based bakes, and family meal deals. As you can see on screen, their current price is £19.03. They have a market cap at 1.94 billion. They have a 3-year dividend growth streak with a 5-year dividend growth rate at 7.87% and a very healthy yield that currently sits at 3.63%. Similar to B&M, I only just recently bought into the stock, so I was able to get it at a very good price, but year to date they are down a massive 31.69%. I own Greggs because it combines everything I look for in a dividend growth stock. Brand strength, consistent earnings, and smart expansion. It's a household name in the UK with a value for money offering that performs well in both good and bad times, and that's exactly the kind of resilience I want in my portfolio. With strong free cash flow, no debt in the company, and a growing dividend yield, Greggs continues to invest in growth through new stores, delivery, drive-thrus, and evening trading, all while rewarding shareholders. It's a well-managed, vertically integrated business that knows how to scale without overreaching. For me, Greggs is more than just sausage rolls. It's a reliable, compounding machine that's in my UK dividend growth portfolio. My UK dividend growth portfolio is built around a simple principle: resilient businesses, consistent cash flows, and long-term compounding. Each of these companies plays a strategic role, not just as individual winners, but as part of a well-diversified pie that balances income, growth, and stability. Together, these stocks offer sector diversification with defence, financials, retail, energy, renewables, REITs, and consumer staples, all balancing the portfolio. And I have a mix of high yield plays such as BATs and Legal & General, and also very good dividend growth stocks like Safestore Holdings and Greggs. I feel my portfolio has very good inflation protection via pricing power with stocks such as BAE Systems and Shell, And as you can see, the portfolio has that massive 5-year dividend growth rate at over 11% currently, with a whopping 5.33% yield. So really, what is there to not like about this portfolio? This portfolio isn't built on hype or short-term trades. It's a foundation of real businesses with real cash flows, selected to grow income year after year. So whether it's through dividends, share buybacks, or capital appreciation, each holding plays its part in building financial freedom through consistency. If you're sitting there thinking, I want a piece of that pie, well, the good news is you can literally copy my UK dividend growth pie on Trading 212. Just one simple click and boom, you're instantly more sensible, more sophisticated, and maybe 3% closer to early retirement. Or at least a free Greg sausage roll every quarter. Links in the description. Don't just watch me collect dividends, join the party. If you enjoyed this breakdown, smash that like button, and remember, if the video hits 100 likes, then I'll do a similar breakdown for my US growth dividend pie. Until next time, keep compounding, keep calm, and collect those dividends. For now, this is the Geordie Pig Investor, over and out.